Holy smokes. Fed Daily just did an interview and she sounds incredibly concerned about the labor market. Like, I was not expecting this at all. We will get into that in just a moment, but first, this could be the biggest combination of coincidences ever, but nonetheless, it is a freak show. That's what Sven Hendrik writes on X, comparing 2007 to 2024. The S&P 500 made a summer high in July on the same day. The Fed cut rates in September on the same day. The SPX made a new all-time high in October on the same day, which was today. Just remember that in 2007, the S&P peaked on October 11th. And in fact, that is correct. Down to a T. I mean, the markets look almost identical to what they did in 2007, and you are here. So if history repeats itself, we could be looking at minimal upside over the next 2 days, and then what was about a 5% correction before the election. Well, I guess technically the election was not in 2007, but still in this end of October timeframe. And then preceding 2007's 50 basis point rate cut from the Fed again on September 18th, you went through a period of extreme volatility really over the next year, where markets had multiple bear market rallies or bear market bounces, but ended up going substantially lower. Now, is history going to repeat itself in the same way of 2007? I actually don't think so. Believe it or not, I'm bearish on markets, but I don't think we need to see a 08, 09, 07, if you will, style recession all over again. Yes, are the data points from 2007 to today eerily similar? Yes. Is the markets eerily similar to 2007? Yes. Is the Fed saying the same kind of things they were in 2007? Yes. In 2007, much the same way as today, everyone thought a soft landing was the base case scenario. That's why markets rallied 3.5 weeks after the first Fed rate cut, which was, again, 50 basis points. Yes, these things are very similar, but it doesn't mean we have to repeat 2007. Now, as I've explained on this channel many times now, and I won't rehash all of it, the reason I'm bearish right now really has nothing to do with a recession or soft landing, because let's be honest, nobody knows if we're going to have a soft landing or a recession. It is far too soon to know that. Following the first Fed cut, which was September 18th. Like, how in the world can anyone say with any degree of confidence that we are going to have a soft landing or even a recession for that matter? Now, statistically speaking, the odds are in the bears' favor. Yes, about 80% of the time, the Fed goes into a hiking cycle, we go into a recession. So if you wanted to make a call right now, the recession call statistically would make more sense. But if we don't go into recession, if we do actually have a soft landing, we won't know that for at least the next couple of months. And really, anyone saying that we've already achieved a soft landing, which I've heard many on Wall Street say, are just full of shit and have no idea what they're talking about. And I would argue that they probably know less than you do. Like, where do we hire these guys at? Like, how do they even have a job? The sad fact of the matter is, these guys that are promoting a soft landing, they get paid via you investing with them. They get paid a management fee 95% of the time. So if they say good things, say bullish things, they get paid more. People do not invest their money when they are scared. In fact, it's quite the opposite. People tend to pull their money out of markets, especially as markets hit a new all-time high today. Wouldn't that be a terrible time to start saying bearish things about the markets? And you make less as a guy on Wall Street. And that's why you're hearing a lot of this soft landing here, soft landing there commentary. Again, I don't know if we go into a recession, but I do know markets are not priced for risk. We're not priced for a slowdown. But in fact, it's actually kind of funny. Because here you can see on screen estimates for the S&P 500 earnings for 2025. They are now back to April of 2024 levels, when the S&P or the SPX was at 5,100 or the SPY ETF was at about 510. So you've actually been falling since about the second week of September. You've been falling for almost a month now, pretty consistently, for your S&P 500 earnings projection for 2025. Yet markets just continue to hit all-time highs. It's almost like these things are completely inversing each other. Like literally from the second week or so of September, S&P's been vertical. It's been going straight up. But yet the earnings estimates are falling. What leads stocks higher or lower, believe this or not, I know it might sound crazy, stocks just don't go down these days. It's earnings expectations. If earnings expectations go up, stocks tend to do well. If earnings expectations go down, stocks tend to not do as well. And you've been seeing a whole lot of that recently. And you know, perhaps this is why the VIX has been elevated, since roughly the same time earnings estimates started to fall and stocks started to go higher. You've actually seen the VIX go from about 15 up to a high of almost 23. Yes, this was October 7th. You've come down, but you're still sitting at 20.86, which is not where you would expect to be, sitting at a new all-time high. For anyone that is not familiar with the VIX, that just means, in simpler terms, without explaining the VIX fully, I think most of you guys understand, it just means there's a lot of people going out and buying puts right now. There's a lot of people that are a little bit nervous. And if you're listening to this video and this is coming to you as new information, you're probably a little bit on the nervous side as well. As I explained in the last video, I do think you've started to see a bit of a short squeeze in a sense, and capitulation that happened today. I know a lot of people hear capitulation and they say, we're not in a market crash. No, far from it. Capitulation is popularized by this overexhausted market that does too much selling and people just throw their hands up and sell, and then the markets rally, okay? It's seen as kind of a bottom when people start to capitulate. Well, the same is true to the upside. When people start to capitulate to the upside, that doesn't tend to lead to the best returns. That tends to roughly mark market tops. Now, not by the day necessarily, but within a reasonably short amount of time. And I think part of why markets have rallied over the past couple of days is a lot of investors, especially big funds, have been in this short China trade, go long US stocks, and China went straight up. Short sellers got burned on those positions. And then as China has, and they were obviously margin called or forced to put up more collateral, they had to sell US-based stocks. And that's what kind of caused a little breather in our markets, a little bit of downside there. And now investors have been able to cover their short bets in China and go back into US markets. And if you were wondering just how strong this market is, well, this is the strongest year-to-date performance since the turn of the century. You have to go back to the late 1900s to find a stronger run. Which, again, I have a lot of cash on the sidelines, but I have probably 80% or so of my stock allocation portion of my portfolio in markets. Like, I am fully prepared for this market to continue to go higher. Yes, would some broadening out further from here be welcomed, in my opinion? Of course. I just find a serious disconnect between the markets having the best year since the early 90s at a time in which we're almost doing the exact same playbook as 2007. Inflation is falling, which is great for consumers, bad for companies. A lot of companies have a hard time boosting margins and coming through with earnings when they're not able to raise prices at all, when the consumer just won't pay those higher prices. That's not exactly a great backdrop for markets. At a time in which you're seeing delinquencies that have skyrocketed, especially for autos, at levels you have not seen since 2009, great financial crisis. I mean, the first thing you default on is usually not your car, right? I mean, how else are you going to get your kids to school or get them some McNuggets? I mean, you kind of need that thing. I guess you got DoorDash these days, but that's way more expensive, right? So you have all of these red flags out there, and the list literally goes on and on. Like, on and on and on. If you have watched any of these videos, you are fully familiar with the bear case for markets. Not because I want the bear case to happen, not because I even think the bear case is going to happen. Just on a risk to reward basis, there is a 90% chance the markets are too optimistic for earnings, for economic activity, and a 10% chance that I'm being too bearish. Or I, should be all in this market, right? There's a very low odds of that. And what's really funny about this is when the markets do fall, the same guys that were saying soft landing and everything's fine, they're going to act like they were first to the party, even though they were the first ones calling this a soft landing, or that the economy was doing just fine and markets are going to be at 6,000 or 6,500 by the end of this year. Some crazy price targets are being thrown out. But yes, they're going to act like they were first and you were wrong. Now, let's get into some of these comments from Fed Daily, and there's so much I could talk about here. This is a very passionate subject for me, again, because I don't have clients. I'm not incentivized to tell you what you want to hear. Actually, pointing out these problems, being the bearer of bad news is bad for YouTube business. A lot of people don't like to click on videos that just tell you how it is. A lot of people want to be catered to their emotions. And right now, obviously, there's a lot of people that are bullish. So these videos really don't cater to a lot of people's emotions. And that's why you see a lot of people, just check out the comment section of this video, that are super negative. Nonetheless, I feel passionate about this subject, about investing. I always have. And figuring out what's actually going on in markets. And it served me very well over the past 10 years or so. Now, Fed Daily, I always say, is it Daily or Daily? I guess you can't go wrong either way. I think it's Daily. Nonetheless, she says that she is concerned about the impact on the labor market, which is something you don't hear from Fed officials too often these days. She goes on to say that she is not concerned about reaccelerating inflation. And Mary Daly says the Fed's goal is to lower growth rate of prices to 2%, not to decrease prices. Yeah, and that's something a lot of people don't understand, saying, hey, prices are going to go down. A lot of people just say that to people and they're going to be, jumping for joy. Like it's going to cost $50 less at the grocery store to buy the same amount of things from 2 months ago, right? 3 months ago. That would be a doomsday scenario for the economy. That would be a bad news. Inflation is better than deflation. Deflation is the devil of economic growth, okay? Because what you see happens, companies take in less money, they need less workers, they have presumably less demand if they're in deflation, and then those people that are laid off cannot buy from XYZ company, and then that company lays off, and deflation. It's this spiral snowball that gets out of control. She goes on to say that business contacts are expressing cautious optimism. And really, why do I say yikes? I mean, if you're a business owner right now, I would hope you're cautiously optimistic. Like, you're cautious. You're not maybe going all in on the business cycle right now, but you're optimistic that things will get a little bit better. Now, people tend to be optimistic in nature. The thing that really sticks out to me is cautious. Okay? People are cautious. Again, human nature tends to be optimistic. We're just optimistic people. That's why we dream big. That's why we try to do this, try to do that, and better our families. That's why you're investing and watching this video. You're optimistic that the bare minimum, these videos, that stock, or that stock is going to better your financial situation and bring you more joy, fulfillment, peace, and a better upbringing for your kids maybe. Who knows what it is for you? Cautious? That's not good. Fed Daily says she does not want to see a labor market slowdown. Now, this one was the real kicker. This one, just like, I think I read this probably like 5 times. Like, am I reading this correct? Maybe 10 times. It says, high real rates could have broken the economy. Now, I don't know specifically if she's saying the economy just broke or if it could have broken the economy. I don't know. With the commentary that we're hearing from Daly, she sounds very concerned. Like, you don't talk about breaking the economy lightly. I don't know, guys. And then she goes on to say increasing the real rate would harm the labor market. So I don't know. But the longer this market just continues to go higher, earnings estimates coming down, it looks almost exactly similar to 2007. Literally is. If markets hit a new all-time high October 11th and come down, then you're literally going to be following October of 2007, September through October of 2007 to a literal T. I mean, now you have Fed Daily that sounds pretty damn cautious on the labor market. A funny payroll report that really boosted the numbers in an artificial way. I don't know, but I'm not feeling any more confident now than I was when the Fed cut rates 50 basis points. I'm not. It was bad then, and it could be even worse now. That's the problem. We just don't know. Even the Fed minutes indicated that the economic data that we're getting right now just may not be that accurate. So let me know what you think about this information down below in the comment section. I don't want to make any crazy predictions here, but kind of as I've been saying the whole time, I'm not too concerned about a large market crash before the election. Could we fall 4 or 5%, 3% maybe? Sure, that's like a bad data report, okay? A bad fly enters the room, and at this point you could fall 3 to 5% given the severely elevated expectations, again, with EPS that has literally been falling for the last month and markets have not responded to it. Like, could you see a rapid catch down of, let's say, 5% in 2 days? Yes, especially heading into the election when you're already in a seasonally dicey period for markets. It's really after the election when I think we'll start to get better economic data coming out. We'll start to get some holiday shopping numbers coming out, at least some initial ones in November. That's when I'm going to be a little bit more concerned if the data starts to come in bad. I know people are still going to try to chalk it up to we're normalizing in the economy and soft landing still here, but I don't know. The more I hear from the Fed, the more I see the kind of wonky data, the more I see the outrageous exuberism in the markets for no reason, I feel like the more I get concerned. And the best thing you can do right now, I mean, short the markets if that's your thing. If you think you can time this out perfectly, I don't think I can time this out perfectly. I think cash is king. I think there will be better buying opportunities. And a lot of stocks still have good value. So if you want to be in markets, I think value stocks, literally value stocks, are trading at really attractive prices for a lot of them. High yielding dividend payers, I mean, can't really go wrong there. I think there's a lot of bad news priced in. And if the economy does do well, there's a lot of upside there. But I don't know. Let me know what you guys think about this down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.